Hello, and welcome to CRE 2021, Transitioning to Recovery, produced by Wealth Management Real Estate. This afternoon's session is entitled The Emerging Role of Crowdfunding in CRE Investing, and it is sponsored by Modiv. My name is David Bodamer. I'm the Editorial Director for Wealth Management Real Estate, and I'll be your host today. In a moment, I will be introducing our speaker, but first, let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. In addition, at the bottom of your screen, you'll find multiple application widgets. By clicking on these buttons, you can open and close widgets on your screen. We welcome questions about our topic and will answer as many as we can following the presentation, but please feel free to submit your questions to the queue at any time. Just type your question into the Q&A window on your screen and hit the submit button. Also, please note that this webcast has been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has also been approved for 1 CFP board CE credit hour, and Investments and Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget. And please note, if applicable, please enter your CFP board ID in the text box of question 1 by clicking on the survey widget on the bottom of your screen. Okay, with all that out of the way, also please be aware that today's session is being recorded and the recording will be available for on-demand viewing. You'll be notified by email when the archive is available. With that, I'm also going to introduce Aaron Halfacre, who is the CEO of Modiv, and who's going to talk to us. We're going to have a bit of a conversation here about what's going on with crowdfunding. Oh, I think you're on mute.
How about that? Can you hear me now?
Oh, there. Yes.
Yeah. Okay.
Perfect.
Thanks, David. Thanks for having me. For everyone online right now attending, my pleasure to make your acquaintance. My goal today is to hopefully make this very informative. By way of background, I've been in the real estate capital markets for, going over 25 years now. I first started out after my master's. I went to BlackRock, spent over a decade at BlackRock, was the head of product development and chief of staff for the real estate team. At the time when I was there, we managed upwards of $30 billion in institutional real estate. I've had the ability and pleasure in my life to have been the CEO of a global equity team, sat on a fixed income trading desk, done a variety of things, worked at a REIT research firm, and then later on went and helped take a non-traded REIT public, and then subsequent to that joined a public REIT that took it private in a sale to a private equity firm. So I've done a variety of different capital markets things. The reason why I'm speaking about crowdfunding today is really to what I think is an interesting and emerging opportunity set. I deliberately left sort of the institutional space about 3.5 years ago and went in deliberately into the crowdfunding fintech-enabled space to learn both as an owner-operator. I've had the pleasure between Modiv and as well as Realty Mogul working in senior leadership positions for 2 of the 5 largest real estate crowdfunding companies out there. And my goal today is to not talk about Modiv. If you want to hear about it, you can certainly follow up with us at a later time, but really just inform people about sort of crowdfunding, give you a little bit of preset on education, and really why it's interesting for real estate and where we could see it growing in the years ahead. So with that, I think the first thing to start with is, I think if we were all sitting in a room together and I said show of hands who's heard of crowdfunding, universally everyone's hand would go up because we've all heard of crowdfunding. Some of us, it's sort of like, a lot of people have a different interpretation of what it is or what they think it is. Mm-hmm. So my goal is to try to level set it a little bit. Crowdfunding, to me, really is a misnomer. particularly as it relates to real estate. What I mean by that is the concept of multiple people or a crowd coming together to fund a large capital project has been going on for centuries. In fact, you can look in history, the foundation or the base that we built to hold the Statue of Liberty was crowdfunding. Right? They had to, investors of the time got together to get ponying their money up to build this base so we can receive the gift from France and put it up there. So this concept is really a misnomer, particularly in the real estate space. But it is the name that is, we've been effectively labeled with. And, you have some shops out there saying they're micro-investing or they're doing this or that, peer-to-peer. But the reality is, for lack of better terms, crowdfunding. But how do we define that? Typically, it's defined as sort of economic funding by a large number of people, typically in smaller amounts, via a website or mobile app. So there's a modern definition associated with it, obviously, the association with technology for websites or mobile app. But if you read that definition, you could easily apply that to Robinhood, Schwab, Vanguard, Fidelity, you name a lot of these places where people are making economic fundings in small amounts via technology. So that in itself isn't enough. We'll go into a little bit more detail of how it's really broken out, but crowdfunding as a phenomena has been growing. It's difficult to find uniform data. I think this reflects a little bit of it's still the Wild West. This chart here that I was able to find, shows that we're around 10 billion. This is global crowdfunding volume, and with a sort of a CAGR of 16%. I've been able to validate that sort of CAGR projection in some other research, but they have different numbers. Like, for instance, they already have us at 20 billion, growing to 50. I tend to lean conservative. I think this is just an indication of the size and magnitude that crowdfunding is a path it's on relative to what is a relatively short history. And so I think it's here. It's sort of under the radar. These are still relatively small numbers in terms of capital markets. We're used to seeing billions in almost every types of large asset kind of play, trillions, if you will, if you look at some of the asset managers. But the fact that it's growing at 16% estimated compound annual growth rate, and it started out with virtually nothing 8 years ago, I think is an interesting trend in itself.
And also, I think that, interesting point on that chart is that it's global. So we're not just talking about U.S. equity. This is something that's happening throughout, in other countries as well. I guess I suppose that they have similar kind of legislation allowing this. Yeah.
And crowdfunding is definitely a global phenomenon. It's not just, I think it's primarily the U.S. That is the case of most capital market events, certainly those on the technology side, that capital markets within the United States tend to be a little bit higher octane, a little bit more entrepreneurial. So there's a lot more development going in on the margin. There's a lot more participants in the U.S., but it absolutely is a global event. You see it in Europe, particularly in the United Kingdom, as well as in Australia, and emerging in a lot of Asian countries too. Crowdfunding, as I said, is a kind of a misnomer. The first modern crowdfunded campaign actually happened in 1997. It was a British rock band called Marillion, and they were looking to raise money to sort of basically to do a concert series and tour. And they were able to raise via an online sort of website protocol $60,000. And so that's the first sort of documented electronic funding by a small number of people. The term crowdfunding was first cited in media usage in 2006. So, fully 9 years after this event, you had, crowdfunding was starting to emerge. No one really knew what to call it at the time. And most of that crowdfunding was what we call rewards-based crowdfunding, which we'll go into in a second. But the term first came about in 2006. But you jump forward another 6 years, and this is where it really sort of became institutionalized, because in the Jobs Act of 2012, they promulgated sort of regulation crowdfunding, regulation CF, and so that's where we really got the moniker that we have today, or we know it today. And the crowdfunding that we're going to ultimately talk about today is this type of crowdfunding. there are over 1,500 crowdfunding platforms out there. And to your point earlier about that slide about being global, there are a large number of them throughout the globe, with the concentration being in the U.S. Some of these logos that I put out down below to show you are just just a handful of the better known ones in the United States. And some of these names you see, you're probably familiar with. Others you're probably not familiar with. And I think it's really a diverse and interesting space in that regard.
Yeah, I think it's, people are probably most familiar with like Kickstarter and GoFundMe, for doing that kind of stuff. But like what you're talking about is like a kind of a new level in what's going on.
Yeah, I think what's interesting about crowdfunding is that its roots stem from the technology space. So you had historically a lot of what I call fintech entrepreneurs who had this idea about using technology to, line people's interests up. I think, to your point, Kickstarter, Indiegogo, GoFundMe were some of the very earliest platforms, and a lot of us probably associate crowdfunding with that sort of that vein, and it is absolutely crowdfunding. But then the fintech entrepreneurs said, okay, how do we, now with the Jobs Act came about, how do we start creating this into a financial services business? You saw a lot of these people who are, younger, technology enabled, around 2012, 2013, 2014, facile and able to tell a good story, were able to raise venture capital. So almost all these historically were launched as sort of venture capital investments, raised money, and then started, building the technology or building the marketplaces or building the brands. And, like any sort of venture-backed sort of space, the barriers to entry are relatively low. If you can come up with an idea and you can bootstrap it or get VC funding, the barriers to success, though, because of that, tend to be higher. Right, so you should see a lot of participants. So you don't have sort of monopolistic powers. You have sort of a real sort of emerging market, a lot of different sort of strategies, flavors coming about, and we've seen that, and that's representative of the 1,500 or so. There's probably closer to 2,000, but we could comfortably point to 1,500 because sort of the Joseph Schumpeter creative destruction process is easily some of these companies are created. Many of them are not making it. They're not surviving for a variety of reasons. Operator error, poor concept. And as we go into this conversation today, we'll focus on the part that's actually doing quite well and is got the legs to transform itself.
So there's a term, on that you've a couple terms they thrown out here in terms of the equity-based crowdfunding, and how does that fit within the context of asset-based crowdfunding? That's where I think you could unpack things a little bit more. Yeah,
so if you take up crowdfunding, I think if you go to Wikipedia or Investopedia, it tends to talk about rewards-based and equity-based. I actually look at it as rewards-based and asset-based. So rewards-based crowdfunding, which is the Indiegogos and the GoFundMes and the Kickstarters and Patreon and things like that, are really that was the earliest forms of the crowdfunding, right? So that British rock band would have been rewards-based. And what I mean by that is you're economically funding, as this large number of people are making small dollar amount contributions, but you're doing so with no monetary return, right? So if I go to GoFundMe and there's a charitable cause and I'm donating $20, I might get a goodwill return from it. I might feel an emotional return, but I'm not getting a return on that $20. I'm not even getting that $20 back. Similarly, if you go to Kickstarter or Indiegogo, you might be, sponsoring an innovator or entrepreneur's new product idea. So you may get a product in return, right? So a lot of people, like the Oculus Rift first started out on Kickstarter, and the early sponsors, if you will, who funded that sort of startup capital got the Rifts. They got the VR headsets. They didn't get the shares, obviously. Those were sold to Facebook, and Facebook took off with that. But that's an example of rewards-based. You're not going to get money back. You're going to get a product. You're going to get a goodwill. Patreon, which is an interesting one, it really is designed for people to support, artists, social media bloggers, content producers, And you can support like the number of episodes that they release, or just put causes in. So it's, again, this is where there's a large dollar volumes in the space. It's an interesting phenomenon. Most of these companies basically get paid a fee, right? So if I go, and it's pretty well disclosed, if you go to Indiegogo or Kickstarter, they're going to get 5% or 3% or something like that, and they're just going to get take a little bit off the top of whatever money. It's just kind of like a credit card transaction fee in a way. So that's rewards-based. Asset-based, and I'll differentiate that from equity-based, is all the type of crowdfunding where it's designed to provide a monetary return. It's designed to be an investment where you're hoping to get a positive ROI. Right? I say it's designed to because, as we all know, as any type of investment, there's the risk of negative return. Right? You could have loss. You could not. You could have an underwhelming return, just like any investment opportunity. So and I say it's asset based because you are investing in an asset. You're not investing in a cause. You're not investing into a product. You're actually investing in an asset. Many of those assets can be securities. Of those types of securities, many of them are equity-based. So I think equity-based crowdfunding is a subset of asset, right? Because if I'm being technical, and I go to a site like Peer Street or Yield Street, and I invest in one of their fixed income instruments, that's not equity. That's debt, right? But that's definitely crowdfunding. I'm definitely investing in it with an anticipation of a monetary return, and so that's how I think about it. And then this is where we've probably had some of the most interesting growth, right? Because this is all promulgated under the Jobs Act, of course. Though I lump in here too sort of peer-to-peer lenders, like Lending Club, or if you've ever heard of those, been around before the Jobs Act. It's peer-to-peer lending. Is it technically crowdfunding under the Jobs Act? It is not, but it is a crowdfunding company in the sense that it's offering financial products in small dollar amounts to investors to participate in. So businesses can do crowdfunding, both debt and equity. Real estate, obviously, where we're going to go into the most detail. And then there's been a plethora of other types of ideas. So art, like Masterworks does artwork, so you can buy, a small percentage of Banksy's latest project or something like that. Alcohol, I lump this in alcohol. There's actually several different wine type of crowdfunding ones, so you can get certain vintages of wine or get access to a vineyard. I've seen whiskey bonds being sold where they were literally selling sort of financial instruments that were tied to production of whiskey, and then at the end of the life, you could convert your bond into a cash payment, or I don't know, 10 cases of whiskey or something like that. Automobiles. This one is interesting. Rally's the company that's one of the bigger ones in this, where they're basically buying sort of exotic or rare cars, and they're holding them in sort of special purpose vehicles like LLCs, and they're selling off fractional interest. Now, not quite clear what the monetary return is until you sell it. I don't think there's any income component out of those types of things. But again, crowdfunding by a large number of investors using the technology. I've seen things like sports memorabilia, like Kobe Bryant's shoes you could invest in. A lot of these are speculative in nature. You could argue from an investor standpoint or an advisor standpoint that some of these are really just design mechanisms for someone to fund ownership asset by using other people's money. For example, if I wanted to start, I'm making this up, but let's say I really, I started islandcrowdfunding.com, and I offered people the opportunity to invest in an island in the Caribbean. And I lived on the island, and you guys basically provided me the equity to live there. And I would tell you that in 10 years, I'll sell the island and you'll get a monetary return. That's what's happening in some of these crowdfunding things. So I don't really think they're mainstream financial service products. They're really ways of using technology in the crowdfunding rule set for someone to raise capital. And there are some websites out there, crowdfunding sites out there, that are really effectively a single asset, or maybe one or two different assets, and they're not a full-scale financial service purveyor like we're used to seeing in our industry. On the business side, I think is interesting. From the business side, you have You have some established businesses who are putting out sort of, mezzanine-like types of debt or sort of corporate loan debt that you can get returns on. But on the equity side, most of it is coming from sort of very much sort of venture startup-like capital, right? So a lot of times we think about Kickstarter, Indiegogo doing it, and there's being crossover and types of things, but like Start Engine, Our Crowd, Seed Invest, WeFunder, there's a lot of these who work under Reg CF, or Regulation Crowdfunding, which I'll talk about in a second, and they're basically offering you venture capital in small companies. Now, this is an interesting phenomenon. It's had great growth. There's a lot of heavy marketing of these. But you have to think about the end investment. It's sometimes this could be I'd say it is highly speculative types of things, because your prototypical business who's starting out raising on one of these platforms is a company or an entrepreneur who either failed to attract traditional venture capital, in one way, or they just didn't want it because it was too expensive. Because venture capital in the traditional sense can be very successful for you, but it does come at a cost. So these people are raising much smaller sums of money, but they might have much smaller operations. They might have a product idea or a business idea. They may not have necessarily the track record. They may not have sort of the financial wherewithal yet. And it's a sort of early stage, back of the envelope type of thing that a lot of these businesses are getting funded. So success could come out of these. A law of large numbers is if I fund enough small businesses, some of them are going to be home runs, and the purveyors of these types of venture investments will highlight those, right? The Oculus Rifts of the world, if you will. But the vast majority of it end up, I gave you $1 million. 3 years later, there's nothing to show for it. The interesting thing, and that's probably why it hasn't grown quite as fast as real estate. And real estate has been sort of the larger and the more successful of these. I can by my own research can easily point to over $1 billion a year being raised by real estate crowdfunding companies. And let's think about why real estate might have gotten more traction than some of these other ones. I think first off, real estate assets in general are large purchases. Right, so these are not, you're not making $10,000 apartments. These are 20, 30, 50, $100 million apartment complexes, or they're commercial buildings, or what have you. Real estate traditionally has been conducive to crowdfunding, or multiple people come together because of the large purchase price. So I think it's well designed for crowdfunding. Two is it's a hard asset. Right, you can go out and you can kick the tire, you can kick the building, you can look at the rent, you can actually measure. This is not a business concept, even though that real estate development does get funded through crowdfunding. A lot of it is income producing real estate, and so income producing real estate reduces the risk, that speculative risk that we talked about on the business side, and I think ultimately, real estate crowdfunding. And some people in the industry that I work in probably wouldn't like this, but in effect, it's an advancement or evolution of sort of the digital syndication, non-traded REIT businesses that we saw before.
Right.
And what I mean by that is, for time eternal, individual investors have clamored for access to particularly private real estate. Right. So people ask me, is private real estate should I do that instead of public real estate? I actually view that you should do both. They have sort of non-correlated returns. A lot of the publicly traded REIT vehicles out there exhibit sort of, SMID or mid-cap type price volatilities because of index inclusions. It's a great way to own it. It's got great liquidity, but it doesn't always provide you sort of that same return profile that you might see in a NCREIF index or something like that. So private real estate has always been enjoyed by individual investors. If you think about, particularly in the Western developed nations, real estate is associated with wealth. That we associate that high levels of wealth tends to have real estate in their portfolios. We've seen it in sort of pension endowment sort of mandates for sure. And so I think real estate has always been something that we've liked. You go back to the 80s, you had lots of syndicators doing deals, and then we sort of had tenant in common sort of transition. And then in late 90s, early 2000s, you had the non-traded REIT sort of industry. And so I think the real estate crowdfunding, as those business models sort of died off for a lot of reasons that we'll go into later, that the demand hasn't gone away. It hasn't been satiated, and so it's now migrating from a non-traded REIT sort of model to a crowdfunding model. So I think that's another reason why we're seeing the volumes that we have.
Right. So that's what I've always thought about it too, is that, even from my seat, that the idea of groups of people getting together and trying to put their money together for a real estate deal, that's the history of real estate.
Yep.
There's whether the structures have changed has been part of that, and this just seems a piece of that. And I think that segues into this question of the regulatory framework, that and how this works, because there are some rules around who can participate. Is that right? And how does that actually work? Yeah,
that's a good point. So thinking about asset-based crowdfunding, and particularly real estate crowdfunding, these really got launched from the Jobs Act, and the Jobs Act established sort of the regulatory framework. And there's three primary regulatory schemas, if you will, that you'll find being offered for both business and real estate, and all asset-based crowdfunding. So Reg CF, as I mentioned before, regulation crowdfunding, was certainly that's where we got the moniker that we know today, but it was created by the Jobs Act. And as I mentioned, it's primarily the business-related types of things. So these business startups are using Reg CF. You don't see much real estate in Reg CF, and that's largely due to the limitation. Up until very recently, you could only raise $1 million, or $1.07 million to be exact, in these vehicles. That's, most real estate projects cannot get out, that's not enough equity. Right, and so that's why now it's increased to $5 million. I'm starting to see some single asset type of plays on Reg CF, but most people just don't go that route because there's a lot of brain damage. But Reg CF really effectively allowed for the raising of private capital with light or very light sort of SEC scrutiny if you're raising it through one of these crowdfunding portals. And so the R crowds and the start engines are all sort of Reg CF crowdfunding portals, and so they're facilitating the structure, and they're basically giving the entrepreneur a turnkey operation, and then they'll go put it on their marketplace and they'll raise the money. How these crowdfunding portals that deal with this Reg CF typically do is they charge a fee that is drawn out of the equity that's raised, and then they end up getting a stake in the company. For instance, Start Engine or our crowd might take anywhere from a 2 to 5% fee of the money raised, of the $5 million raised, and they might also retain a 2 to 5% equity stake in the venture. And that's how they get economically compensated. So it's sort of transaction driven. And their costs are, one is trying to source it's what I call a two-sided marketplace. So they're sourcing all these entrepreneurs who want to raise money. So they have to go and spend money to kind of attract these people and say, come to our site versus someone else's site, and we'll help you raise money. We're more successful. And then on the other side of it, they're trying to advertise to all the potential investors to say, come to our site because we have got the better crowdfunding companies or the better new businesses to invest in. So they're spending this money in that manner. So I think Reg CF is interesting because it started out in Jobs Act, but it's not overly relevant to real estate given its limited size. The two that are more relevant, and the one that's actually came about from the Jobs Act was Reg A Plus. Reg A Plus would deem sort of as a mini IPO, so it's designed. The premise was it was designed to allow a company to have a registered security in all 50 states, so blue sky applicability, at a fraction of the cost that it would take you to do a traditional IPO where you engaged a banker and you went on to, did a listing and things like that. So Reg A Plus has more SEC scrutiny than a Reg CF. So when you file, your initial filing, which is similar to, say, an S1, but it's got a different nomenclature, or an S3 or an S11 or any sort of public registration filing that you might have to do, you file it. The SEC has the right to review it, provide you comments, then they have to deem it effective, and then once it's deemed effective, you're able to now start selling securities. It's basically you're selling securities, but there's some, you can do it exempt, and then you're tasked with periodic financial filings. Not as onerous as a 34 Act reporting company, so you don't have Qs and Ks, but you do have sort of you have a long period of time, but initially 2 years before you have to, your initial filing before you have to do an updated filing, and then after that you have to do semi-annual updated filings. There is an equivalent of an 8K if you're familiar with an 8K filing. So any type of material information that goes out has to be filed with an 8K if you're a 34 Act reporting company. The equivalent here is called a 1U. So if I'm under Reg A and I've made some sort of material transaction, I file what is called a 1U. So it is a public vehicle. It is technically public, and by being blue sky and being relegated to everyone, it means non-accredited investors as well as accredited investors can go into the vehicle. When they first started it out, they wanted to limit it. And I'll be talking. There's tier 1 and tier 2, and I won't get into that too much. Most of the real estate crowdfunding companies use tier 2. It's the higher dollar limit. It used to be $50 million raised in any 12-month period of time, and it was recently increased to 75. So on a recurring basis, if you will, someone under Reg A Plus could raise a little over $6 million each month continuously, because in any 12-month period of time, you wouldn't be more than $75 million. Now, some people do it as a continuous offering. Some of them do it as a closed-end offering where they raised $75 million as fast as we can, and then it's closed. But the increased dollar amount has helped facilitate more and more product in that space. The last one is Reg D. Now, Reg D did not come about from the Jobs Act. First came about in 1982. There was sort of 504, 505, 506. I think we've retired 505 now. There was 506B, and now there's 506C that did come about. 506C is interesting because it allows for general solicitation. Reg CF and Reg A Plus also allow for general solicitation. Why is that important? General solicitation allows us to digital advertise, to use social media, which is essential to crowdfunding. When I helped a non-traded REIT back in the day go public, we had filed under what was called an S11. So an S11 is a typical registration offering for a REIT, but it only allowed you to do tombstone advertising. So tombstone advertising is I could talk about a particular property we bought, but I couldn't talk about the securities themselves. So you couldn't go and advertise that we've got shares for sale. Under general solicitation rules, you can do that, but more importantly, you can do that digitally. So you can go and people will, and so the way, if you think about this, is a direct-to-consumer model, right? So there's less intermediaries, and so they're literally retargeting on Facebook or LinkedIn, or they're doing a podcast, or they're doing these different forums to try to get people to, and they're selling that security. And so Reg D, under the general solicitation, it has been popular with crowdfunding companies too. Some people do 506B, which does not allow for the same. You have to have known your customers, and so if you've already built a database of leads, then maybe they'll do it under 506B. The big key about a Reg D is that there is no limit at all. So you could raise $100 million in 1 month, and there's no handicap. The other thing, the constraints is that it's only allowed for accredited investors. And there's been a lot of talk in the marketplace about accredited investors only. The other thing that you should note that is there is no SEC scrutiny. You're technically required to file Form D that lets people know that you did a private placement, but there are no financial requirements, there's no audit requirements, and so the investments can be very opaque and the transparency low in some of these Reg D offerings.
So Reg D is the only one where accredited is where you have to be accredited. Is that right?
Yeah, that is correct. Yeah.
Okay. And is there any sign that might change, or is that threshold appropriate?
There's been a lot of talk about, is the accredited investor threshold, too onerous? And back in 2019, the SEC put it out for review and feedback for people's, ideas about what they should do with it. And they recently made a very marginal adjustment to the standards. So the standards are, you have to have a certain income requirement. if you're filing single or joint, and it goes from 200,000 to 300,000. So 200,000 income, documented income that you can show if you're an individual, or 300,000 if you're married filing joint, or you have to show that you have $1 million of net worth, excluding your primary residence. That was the standard for a long time. That still holds. They've now allowed, if you are a registered rep, so if you have your Series 7 or something like that, then you now are deemed to be a accredited investor. So you don't have to have the income requirements, but if you're a Series 7, you're deemed to be accredited and sophisticated enough to do this. There's been a lot of people saying we should lower these standards, right? These are too high. A vast majority of Americans don't qualify on these. And I've seen some people, push that we should lower that standard. I actually think, and I'm probably a minority in the real estate crowdfunding side, because of my institutional background, maybe because I had come from a highly regulated environment with BlackRock and Schwab and all these things like that. I actually think it's there for a reason. And what I mean by that is because the Reg D offerings are private placements, they do not have filing requirements. They do not have audit requirements. They do not have transparency requirements. They do not have any liquidity requirements. These should be deemed speculative investments. Now, sometimes they're great investments and they're not speculative, but they should be categorized as speculative investments. And you need to have a certain financial wherewithal or certain financial sophistication to sustain what could be, sort of a catastrophic loss. If you make an investment in a Reg D and it doesn't work out, it should not wipe out your entire net worth. It should not sort of devastate the good standing of who you are as an individual. Not to say that humans can't do the same in a publicly traded stock market. They can go and put all their money in and wipe it out. We've heard stories about that in Robinhood apps and things like that. But I think Reg D environments don't have liquidity, they don't have transparency, they don't have audit requirements, and so this is a safe harbor. Making sure that someone has a certain net worth protects those investors. When you're selling a Reg A product to anyone who can click on Facebook or something like that, I think having the public filings and the scrutiny, even though it's not overly onerous and it's designed to be a balancing act between bureaucracy and protection, I think it works. My view is that we're more likely to see the Reg A sort of threshold increase from 50 to 75. There's been talk about 100 and so on as it gets more accepted, because then the SEC can still have a process to review the securities. They're subject to the SEC rules, and it's a lot better way to police it, and you're allowing more people in. I think most of the reasons why you hear people say we want to lower the accredited investor threshold is they just want to raise more money. And it's hard to raise only from accredited investors. Right. There's this whole sea of non-accredited investors they want to get to, but they don't want to be subject to rules. And so I actually think increasing the threshold to Reg A so that you could raise $100 or $200 million allows some larger institutional shops to say, okay, well, I'll venture into this space now because I can raise $200 million for $1 billion project. And they can do it with the SEC scrutiny.
Interesting. Okay.
Yeah.
That answers a lot of questions that I've always had about crowdfunding. So thank you so much for that. I think now we're going to segue into some of the specific structures further. So if you can, just want to dive into that. Yeah.
So, okay. We're talking about crowdfunding and sort of this nebulous concept. We get the concept, the belief system that you're funding real estate, but how are you funding it? What are you actually owning? What are the securities that you're taking ownership of? What is this asset base? What are these assets held in? And there's about three sort of primary structures. A lot of the crowdfunding you might think about real estate, if you go to a certain site, like I'll give an example. CrowdStreet is probably one of the better examples. A very successful company running their business model very well is what I call the Monopoly card pictures. So if you go to their site, you see, I liken it to Monopoly card because there's this little diagram and it's got a picture and it's got all these little stats like IRR and equity multiple and things like that. And I liken it to like if I had a bunch of Monopoly cards, I want to buy a little bit of Park Place, or I want to buy a little bit of Baltic Avenue. It's kind of the look and feel. Most of all these are single assets, so they are crowdfunding a single real estate deal. Those single real estate deals, with very few exceptions, are just dropped into an SPV or special purpose vehicle. Usually, it's an LLC. Oftentimes it's a Delaware LLC. So it's a bankruptcy remote vehicle, and you're basically in a partnership, right? You are the limited partner investing in this, and the sponsor of that deal is the general partner. These heretofore have been Reg D offerings. So it's light registration. They don't have any audit requirements. They don't have any liquid, all the things that I mentioned before. As such, you're getting a K1, which I know personally with a lot of financial advisors that I have known over the years. Look, they deal with K1s, they understand them, but they're kind of cumbersome, right? When you can get a lot of 1099s, you can drop it into your back end if you're using a Schwab Advisor Source, or you're doing you're using a third-party application to do all your sort of record keeping, your transfer agent stuff. Getting 1099s and helping them with their tax returns is very easy. K1s are very messy, and they usually come late, and it's never timely. K1s are a part of the life if you own real estate directly. So people understand that if they're owning some sort of direct real estate investment vehicle. So K1s are out there, but they're not always liked. But single asset LLCs have these. They're almost I don't know of any open-end ones. They're closed-end. So it means they raise the money, they put the money toward that specific project. That money stays there. Your principal stays there until they've taken that property full cycle. So that maybe it's an apartment building and it's got high vacancy and it's a little bit dated, and they're going to go take your money to buy the property, and they're going to have this reserve on top of that, and they're going to renovate the units, and they're going to drive occupancy up, and they're going to increase rents, and in 5 years they're going to have sort of cap rate compression. They're going to sell it for a good gain, and then you're going to get your money back. That's the typical business model. These, by nature, are sort of value-added or opportunistic. You can have, sometimes they could be development or large-scale redevelopment. They certainly have the value-added flavor that I just described about apartments is very common. They also tend to have high leverage, right? Because you're only raising so much equity, and there can be a lot of hands in the equation. So you've got the general partner who wants it's usually getting fees to manage it, and fees to buy it, and fees to sell it, and fees to finance it, and they're getting the promoted interest. And then you've got the fees of the person who helps syndicate it, so the crowdfunding platform itself. And so a little equity, a lot of leverage is a lot of times how they do those types of deals. So that's a little bit unique. I think that reminds me of the tax syndicate days before the S&L crisis. That was a lot of single asset types of syndications, usually large scale development projects. If you remember back in the days, you could have accelerated tax depreciation, so people were syndicating money just for the tax losses. We can't do that anymore, but for a long time we moved away from single asset types of syndication, and we moved towards commingled vehicles. So blind pool funds are pretty common. These are they're generally value-added or opportunistic, but some of them are core, and they basically say, look, we're going to go buy a bunch of apartments. We don't own any yet, but these are what we're going to buy. And a lot of them are being done under Reg D, just because it's, they're usually sold on the same platforms they're selling the single asset ones. So if you like their single asset deals, you'll like us buying them for you. And a lot of them, the flavor is it's curated, right? So if I go to a site and there's 20 single asset deals on there, or they're popping up every week, and I'm busy, I got a life, and I don't want to go look at every deal, but I do want to have exposure, then some people are going to these blind pool vehicles where effectively the crowdfunding platform is curating the investment. So they are actually putting in some of this money in this blind pool fund into these single asset deals. So it's kind of a fund of funds concept where they're just getting, look, we've got 5 deals going on, we're going to put a slice of all 5 into your fund, right? So you're getting diversification, and you're limiting your workload. And these, you have those property level fees that we talked about before, but you also have fund level fees, right? So you tend to have a double layer of fees. REITs, obviously a REIT day one starts out as a blind pool fund, but REITs have a different tax election. So as many of your investors or members participating here have realized, so REITs avoid the double taxation of a corporation, and so as long as it's distributing out, it is taxable income. REITs have been around, the modern REIT era has been around since 1992 with the UPREIT structure, very favorable, very public and private sort of thing. REITs are sold under Reg A plus and Reg D. So there are some shops out there who are doing Reg A REITs, and there are some that are doing Reg Ds. If you think about the old non-traded REIT days where you had sort of, the Griffins and the Inlands and the CNLs and the Wells and, Cole and ARCP, all these were, they were sold under an S11. So they were allowing non-accredited and accredited going, but they couldn't do general solicitation. They were only sold through financial intermediaries.
Right.
These REITs are doing direct to consumers or direct with the advisor, but it's an independent advisor typically. And these are giving 1099 dibs, so something that we're very familiar with. Most of them are core because by the time you're a REIT, you're going to be established, you're going to be income producing. It's almost impossible to raise a REIT that's all speculative development. But you could have value-added REITs in there. You could have value-added components for sure. Most of these, unfortunately, are still externally managed, just like the non-traded REIT business. Whereas we think about public REITs, the vast majority of them are internally managed so that the employees or the management team, work for the shareholders exclusively. And those that are externally managed that are public usually trade at a discount or not favorable. In the REIT space, kind of like the rest of the space, the fees and liquidity vary widely. So it depends on the sponsor, depends on what their motivations are. It depends on the demands of the investor. So when you think about, you got these three primary sort of security types or structures, then you have to think about the business models because there's a lot of diversity in the business models here. I've tried to break it out really as a spectrum, and the left and the right are the sort of the bookends of the spectrum. There are the syndicators, which I kind of talked about digital syndication. I'm going to get a little bit more specific there. And then at the other end of the spectrum is asset aggregators. And then there's others that are sort of a hybrid of these two. So as I talked about on the Reg CF, how those type of people who are looking for small business entrepreneurs and they're finding small business investors, that's a two-sided marketplace. Syndicators have that same phenomenon. So the syndicators that I'm thinking about is that CrowdStreet model. Real Crowd is another example. There's a couple of them out there. They are doing the Monopoly card sort of photos on their website, and they have to spend their money, and their general solicitation has to be one for sponsors. So they're not sourcing the properties, they're sourcing the sponsors of those properties. So in the early days, almost all the syndicators started out with residential fix and flip loans. So this was in 14, 15, 16 a little bit, residential fix and flip loans. That dried up, and so they started to pivoting to, tends to be the multifamily projects. And then now they're starting to get more and more into traditional commercial real estate investments, sort of office, industrial, retail, self-storage, et cetera. So back in the early days, and even still today, but it's gotten more advanced, is you could have an acquisition guy or a guy who just happened to, had a lead on an apartment building and got it off market and said, oh, I want to do this. I'm going to bootstrap entrepreneur, which has happened in real estate for time eternal, right? So guys just get together, or girls, excuse me, and they get together and they say, like, I found a property, I want to raise some capital, and then I'm going to go run this and flip it in 3 or 5 years. So with the advent of crowdfunding, a lot of these GP sponsors, general partner sponsors, would go secure a property, get it under contract. They would put their friends and family money in, but they still needed some more equity. Because it's a multifamily deal, most Fannie and Freddie financing gives you like 70 to 75% financing. So you're only coming up with a fourth of the equity, fourth of the total purchase price is equity. And they would come up with, they wouldn't even have all that. So then they would go to a CrowdStreet or a Real Crowd and say, hey, we want to raise some money. They put the deal deck together, they take the picture and then put the Monopoly card up, and CrowdStreet raises the money for them. And they've had great success. CrowdStreet did last year over $600 million of volume. The year before, they did over $500 million of volume. This is not volume on their balance sheet, but it is volume they're doing for other people's balance sheets.
Right.
I remember an example where I think $8 million was raised in 6 minutes. So these are, when you've got all your investors. To do that, though, so not only is CrowdStreet as an example, not just CrowdStreet by themselves, but CrowdStreet as an example, not only are they cultivating and attracting sponsors who have deals, and there's competition. They have to compete against Real Crowd and other sources to say, look, I'm a better I can raise your money for you faster, et cetera. They're also spending time and money attracting investors, right? So they're getting people who want to invest to go to their website and look on a real-time basis and make these investments. So they have to spend money, developing what I call as a two-sided marketplace. It's transaction volume driven. So CrowdStreet's success requires there to be product and to be investors. And so it's volume driven. In some ways, you could think about this as like if you're familiar with CRE or 10X, which are these real estate auction sites, or if I think traditionally like CBRE or Cushman or Colliers or Newmark, Knight Newmark, these are real estate commercial brokerage operations. They're kind of doing the same. They're finding people who want to sell a property, and they're finding people who want to buy a property. It's very transaction driven. There's no sort of annuity stream, if you will, to that type of for the crowdfunding itself. Because of this, because you have an intermediary who's helping a transaction, you have agency considerations, right? You got to say, are there alignment of interest? How are they getting paid? Added layers of fees. But that is really where real estate crowdfunding got its roots. That's where it started out in its earliest form.
Okay.
At the other end of the spectrum is what I call asset aggregators. Modiv is an example of this. Fundrise is an example of this. We are not building a two-sided marketplace. We are obviously raising capital, just like a traditional real estate shop or PE shop would do, and then we are buying assets. We own title to those assets, and we're managing those on the behalf of investors. Asset aggregators tend to use the REIT structure. So we use the REIT structure. Fundrise uses the REIT structure for sure. And so this is the other end of the spectrum. Here you have the externally, internally managed considerations. Modiv is an internally managed one, just like a public company. Fundrise is an externally managed model. The fees vary widely. As an internally managed company, for us, we have G&A, the normal cost associated with operating a company, just like you would at IBM or Apple, but we don't charge fees. There's no outside party getting paid a fee. So that removes the conflicts of interest. There's still absolutely the cost of doing business, but there's alignment of interest. If you have an external manager, then the external manager is getting paid either on assets under management or buying properties or both. And so sometimes that can create conflicts. You have to have good corporate governance to manage through those. In between these two is you have the hybrid model. So you have people doing fund of funds, and you have people doing, so they're doing the syndication, but they're doing it in a structure where they're getting AUM fees, and they're also offering sort of REITs. So they're doing sort of both of these. Realty Mogul was an example of that, one of the early adapters of that in terms of a model. So you have a full spectrum here of how these crowdfunding companies work.
Wow. And so given the kind of the flavors here, the complexity, what can you kind of cover some of the considerations then if you're interested in approaching this?
Yeah, look, any type of investment you're going to do, I always, at least from my perspective, I always want to look at the fees, right? Who's getting paid? I've long been sort of loved the story of John Bogle and how he thought about Vanguard, and he had come from the mutual fund industry where you could get away with front-end loaded shares and all these other things, and sort of focusing on expense ratios. I think we unfortunately right now crowdfunding, real estate crowdfunding, is not as hyper-focused about fees as it should be. I think it's coming. I think more and more people will be. Sophisticated advisors are not going to, maybe a lot of them have had prior history with some of the non-traded REITs. They're not going to do that again. They're going to make sure that there's low fees, there's reasonable structures, that there's alignment of interest. So I think fees is a big one. As I talked about before, sort of corporate governance, I think that's important. It's easy to form a structure. It's easy to have a crowdfunding platform. It's easy to form an LLC. It's easy to go put money into it. But then that's really gets important. What are the day-to-day decisions being made? Are they really in the best interest of the shareholders or the investors, or are they in the best interest of the sponsors? So good corporate governance is absolutely critical. And we don't have to reinvent the wheel here. We have good corporate governance models from the public side of the space that we've had for decades. And I think following those best practices is the easiest way to get alignment of interest. Part of alignment of interest is transparency, right? Making it be known that here's what our financial results are, here's what we're doing. That's why I like the Reg A, I like the SEC scrutiny, because it requires transparency. even for those people who don't want to do it. We believe in transparency. We are public finance, so we're a 34 Act reporting company, so we file Qs and Ks. We actually do earnings calls, even though we're not listed. We're non-traded. We're not yet listed, at least. And so we do earnings. We do everything like a public company does, except we're not traded on a New York Stock Exchange right now, for example. So I think that's something to consider. I think the last thing is risk awareness and management, right? It's easy to find a property. It's easy to invest in a property. It's not easy to manage your investments, right? So as we look at about financial products, be it traditional asset classes like stocks and bonds or real estate or other types of alternatives, you look towards the leadership qualities of the team, you look to the experiences, you look at, are they measuring risk the right way? They're not focused on just returns and fees, but they're, do they have the infrastructure in place to do so? I think these are really important for long-term sustainability and return on capital. And again, we don't have to reinvent the wheel here. We have lots of best practices to point to in a very established financial services market.
We're getting close to the hour. I want to grab a quick question real quick,
Yep.
and then before you wrap up, that we got that came in, which is how is a property purchased by a crowdfunded company titled for ownership and tax purposes?
So the individual asset ones, they're going to be put into an LLC, and so you're going to get a K1. You're going to own a partnership interest. So if you're doing a single asset LLC crowdfunding deal, it's going to be titled in, like, let's say the property's on 123 Main Avenue, and they're going to call this SPV or this LLC 123 Main. And the general partner will be the sponsor of it, and you're going to be a limited partner, and you're going to get a K1 that says you own, a 1% interest in 123 Main. And so the securities of 123 Main, the property is owned by the LLC, and the sort of LLC operating documents govern who controls that asset, which is going to be the general partner. If you're owning in a REIT, you're owning a security.
Got it. Okay, so I think you got a couple more. You want to just get us through the last kind of big points here, and then we'll.
Yep. So I think we kind of give you a sort of lay of where we are today. Where is it going? Why do we care? I think it's not all that innovative that some individual sponsor can raise a deal. I think what's innovative here is that we're seeing this get more mainstream, more acceptance. As we get more dollars put in, that'll attract more other dollars to come in. So there's a scale effect going on. Fees will lower, better governance will be instituted. It'll become more and more mainstream, more and more institutional. And I think that creates an opportunity that will, if more capital comes into it and we get better practices, that means that it will lower the cost of ownership even further for real estate, and that will drive real estate asset prices. Because as more capital can come to it, if you look at equity markets as an example, equity markets over the last 50 years have continued to grow. As access has been increased by different technology and better ownership structures, the same is true for real estate. So I think it'll be a good capital markets effect. We'll see pricing in that. I think also the thing to think about is there's some parallels. If you go back to May 1st of 1975, the May Day Act, that's when we deregulated stock commissions. In 1978, Vanguard started to launch the no-load mutual fund. These were the early signs in the traditional financial services of people improving the financial structures, reducing the cost of ownership, and trying to get more access to people, right? Both of these models, so the discount brokers, which I liken to syndicators, and mutual funds, which I liken to asset aggregators, were direct-to-consumer facing. Right, and so over time we had a lot of discount brokerage shops out there. We had a lot of mutual funds, and we started to see convergence. So convergence is not the same as the hybrid models above, but there's some similarities. For instance, Morgan Stanley acquired E-Trade and Eaton Vance. Right, Charles Schwab started out with discount brokerage, but offers mutual funds. Fidelity and Vanguard started out as mutual funds, who offer now discount brokerage. And so they are mainstream accepted companies, and that same parallel I think we're going to see in the real estate crowdfunding space.
Oh, that's fascinating. Well, you packed so much in here. I think we probably could have done 2 hours, because there's just so much ground to cover on this, and I know that I learned a tremendous amount. So thank you so much for going through all that.
Absolutely, appreciate it.
So I know we got a few other questions too that I just don't think we have the time for, but we're going to share those with Aaron. He'll be able to follow up offline. I'm sure as well if people want to reach out that be happy to answer anything.
I'm an open book kind of guy. You find me, I'm very transparent. You can find me on the LinkedIn. You can find me at Modiv.com. Happy to have follow-on conversations. Clearly, I'm passionate about this. I think there's a lot of interesting things going on, not just because I'm at a crowdfunding company. I think this is good for investors. This is good for the financial services industry, and I'm happy to talk about it to anyone who wants to ask questions.
Great. Well, thank you again for that amazing presentation. I'd also like to thank Modiv for sponsoring today's forum. And I'd also like to invite our audience to check out the other programs that are part of this forum. To register, simply click on the upcoming forums widget located on the bottom of your console. We'll also be sending out the recordings for everything that we've done this week as well. So for follow-up. And so you will receive a follow-up email that does include a link to view the recording of today's presentation. So if you did find this useful, we definitely encourage you to share it with your colleagues. In addition, once you leave the event, a short survey is going to pop up in your browser window. So we'd appreciate if you could share your feedback on this event, as it does help us to provide you with the best content going forward. So on behalf of Wealth Management Real Estate, thank you for tuning in, and have a productive remainder of the day.
Thanks, everyone.